we're going to stay up with QQQ to about 8%. So if QQQ is doing well, up to 8%, we'll capture that return. Above 8%, that's where we have that cap, as Subui was talking about. That's the cap side of it. And then on the downside, we have a lot more protection there. So I think when we were last checking, about a 20%, if QQQ went down 20%, the portfolio, that fund would be down about 5 to 6%. So, and our thoughts there was the probability of QQQ having a double-digit return like it did the last 3 years was less likely than us having a pullback. And that was also, as Sabri mentioned, not only due to valuations, but this is a midterm election year. And what we've seen historically is during midterm election years, you have a lot more volatility leading up to the election. But then after the election, the following 12-month return is generally significantly better than a non-election year. And we wanted the buffered ETF. Currently, our thoughts and strategy on that is to get out of it around August. That way we can move back into QQQ and large cap growth potentially if things are looking well, and hopefully capture some of that upside after the election. So those were a lot of the big changes that we made. We did make a couple changes to some funds, and that I think we're going to look at sending out executive memo on some of those changes to everyone. But so this is probably the biggest changes we've made to the models since we started doing the model management. So, Saburi, anything else you want to add to that, Todd?
Yeah, just to reiterate, we can't say exactly what it'll end up being, but that cap on the upside for QQQ is not through the end of the year. This product has an expiration date at which time you can either get out of it or you can roll into another buffered ETF to extend that protection. And that expiration is in August. So Matt referenced that. So that 8% would be, between now and August. So on an annualized basis, that would be double-digit returns again on an annualized basis. So, we still have room there to run up if QQQ, kind of gets its act together. The last few days have been a little rough, but that's exactly why we put this downside protection in. We're expecting a lot of volatility here. There's, again, the whims of the AI sentiment. Google just came out with a blowout earnings announcement, yet they were down a couple percent during the day, down as much as 7% after hours, because they announced that they are going to be spending about twice as much as what Wall Street was expecting on AI build out just in 2026. And the market reacted very negatively to that. So whereas just a little while ago, the market was applauding deals and investments around AI. So a lot more volatility, and sentiment is a lot more wishy-washy right now. So we just thought it was a good time after a nice 3-year run to build in some downside protection there. And again, we can revisit that, and we can get out of that buffered ETF anytime we want. Like, we're not stuck in it until August. But we do have that downside protection if we decide to keep it in place through August. And then, we're going to be constantly monitoring this and determining what our next step is from there. But we thought it'd be important. Like Matt said, this was a pretty significant change in the model. So we wanted to address that tonight.